All right, guys, we're going to be looking at a IPDA data range example, and we're going to be focusing on the Australian dollar. Now, if you've noticed, we've had a little bit of a run-up on Aussie, and we're going to break this down a little bit in context why I was expecting the levels that we're looking at now to be hit, looking at the charts that we share on the forum. So if you're not paying attention to those charts, or if you're not saving them, it might be a good idea while we're doing this month, not that I'm encouraging you to do this throughout the mentorship, but when we do daily reviews, I'm taking you basically to the points at which I'm drawing my attention to on my own journal, how I have reference points on my own charts. What you see me noting on those daily entries on the forum, they're the points at which I'm keeping focus in my own journal, and any salient points that would be in addition to those levels, I will make in terms of commentary. But the month of January, when we do these daily entries, where I do the dollar index, the euro dollar, British pound, US dollar, dollar CAD, and Aussie dollar, when I share them with you, don't just click on them and wait for some kind of a neon sign and say buy here, sell here. I want you to be focusing on what I'm drawing your attention to, and then watching how price moves to these levels. Regardless of what type of trader you're going to be, you're going to need to be focusing on how that happens from beginning or from foresight to when now we can talk about it in hindsight, because all these things are going to help you prepare yourself for when you anticipate something, and then waiting throughout that process, because it's quickly learned by simply looking at a hindsight example where I can say, hey, okay, this is what we said the market was going to do. This is where we thought the market was going to happen. And here it is, bang. When you see it in the charts and your attention is drawn to it beforehand, there's a submission to time that's required. And unfortunately, we gloss over that many times, even as educators like myself. It's hard to communicate what's required in terms of having to wait for that thing to unfold or develop in the chart, just simply because we have a level or an order block or a target even for price to get to. When you show a hindsight example, that part of the lesson, which in my opinion is that's the main point you have to learn. You have to learn to wait for these things to unfold. The impatience that the market presents us an opportunity experience is overwhelming sometimes. And while I'm many times accredited for being very patient, I am not really a patient person at all. I'm very impatient. That's the reason why I don't do long-term position trading. But I'm going to counsel you to go in every single day when we do our daily entries for the content, whether it be a video review, or whether it be a teaching, or if it's something along the lines of just simply providing the charts. You want to be really copying those charts, printing them out. Hold me to the standard of, if I know what I'm doing, then it should be evidenced in this. Okay, for the most part, we've seen many times that occurring, but for your learning, you need to say, okay, this is when this was noted. This is when the observation was made. So how long did it take for this to occur? Now, since January is focused primarily on the daily chart, obviously each daily candle, when it paints and closes for the day, it obviously takes 24 hours to do that. So yes, we can glibly say it takes 24 hours for this candle to form, and this is what it takes in terms of the setup or level being reached over this period of time. It took 3 days or 4 days or 2 weeks. You need to experience that. You need to be being mindful of how long those things take, especially on these higher time frame charts. If you don't do this, and you're new, or you're just a relatively inexperienced trader, some of you that are in my group that have been trading for a long time know exactly what I'm referring to. There's a big gap in between learning something with examples and hindsight and textbook, and even being taught something in a webinar or a workshop live where people say this is what happened in the marketplace. It's missing that element of having to endure what needs to be weighted upon to come into your chart. You can't just simply say, okay, well, this is the outcome I'm expecting, and therefore, it needs to happen on my time. That's the part that kills traders. It was very influential in my early days as a trader because I needed it to happen right away, because when I first started trading, things were moving quick. There were fast markets. And then when I realized that it wasn't like that always, it was a very big struggling point for me. So just go in every day, gather those charts up, print them out, keep a running log of them. In fact, it's probably a good idea just to print them out every day and just get yourself a 3-ring binder, punch some holes in it, date them, okay, and then keep track. It's a good reference point to go back on Saturdays and Sundays on the weekend when we're not really doing anything. Go back and look at what was observed before the fact, and then how long it took for these things to develop and those levels to be reached, and what was the response after it got to those levels. Okay, so it's important you go through the mentorship with that in mind. I'm not just showing you trophies or, just things in passing. I'm really trying to draw your attention to something that I want you to focus on and study how long it takes for these things to come to fruition. Okay, so let's get into the Australian dollar example for the IPDA data range. All right, so we have here a futures chart. Okay, this is the March contract, the underlying daily chart of the futures contract of the Australian dollar. And by looking at the futures contract, if we're going to be trading Forex, okay, it's really important that you know that you can get a lot of insight just by studying the underlying futures price. So if we're going to be looking at the Australian USD pair as our case study, we're going to be looking at how influential the study of just the futures contract alone, how that's paramount in understanding how that moves right into and segues beautifully into trading in the foreign exchange market. If I were to do a poll right now, and if we were all in the same room together, okay, and we simply said, hey, look, I've never traded Forex or I've never traded futures. If you were studying one or the other, I guarantee you a large percent of you, probably 80% or more, never really refer to the opposite in terms of the analysis. So what I mean by that is if you're a futures trader, you've never considered what the foreign exchange market's doing. Or if you're a futures trader, a Forex trader, and you've never considered what the underlying futures contract is doing, vice versa. It's imperative that you understand what they're both doing. To get a complete picture, you want to be looking at both. Now, obviously, right away, one's going to assume, well, it should be the obvious. It should be the same thing because the Australian is leading the pair, Aussie versus the dollar. So therefore, the Australian underlying futures contract should be, in fact, the same thing we see in the foreign exchange market. And by far and large, that's true. But there are certain data points that you cannot get by looking at the foreign exchange market. There's simply no way of getting that because foreign exchange doesn't give you volume. It doesn't give you accurate volume like you can get volume from the underlying futures contract. And we're going to talk more about that as we go. But I want you to take a look at this chart here, okay? And I'm looking at a little bit less than 6 months. I wanted to show just this data range because outside of this, the chart becomes spotty because it is a futures contract and it's March delivery. So that means prior to March, we had December's contract, and that's already expired, and now we're trading in the nearby contract, which is March 2017 Australian dollar. When we taught, or rather, when I taught the IPDA data ranges, okay, obviously I asked everyone to hold off sending me emails, but some of you were just overzealous and want to know it right now. And these are things that we're going to be building on your understanding as we go through the mentorship, especially through January. But I want you to focus, when you look at your daily chart, just simply go through and look at the last 3 months, okay? Start whatever time point you're looking at. Like right now, let's assume we sat down with the charts right now. And this would be the first day we're looking at Australian dollar. We're a brand new trader, brand new to the concept. We're sitting down. How would we go about looking at where the IPDA data ranges are? And if we're looking at Australian dollar, you want to go from today's candle, which is what's being painted here. That, and it's not a candle, I know it's open, high, low, close, but you're going to have to suffer through that, okay, because I had to get these slides together, and I promise there will be candlesticks shown, but for now I want you to focus on this because the open, high, low, and close is important. The most recent market shift, okay, in the last 3 months occurred back in November. Now, I know some of you that are hardline critics are saying, well, here we go again. This is a hindsight thing. This is where hindsight is gold. You need to know what I'm going to show you in this teaching because it will clarify what the IPDA data ranges are actually supposed to be doing for you. Some of you are thinking that it's going to call the high and low 20 days, 40 days, and 60 days away. That's not what happens. Sometimes it can hurt, sometimes it can occur, but that's not what its job is, okay? The question that comes up a lot is when I'm looking for a order block to buy on, or if I'm looking at an order block to sell into, or if I'm looking for an area of buy stops or sell stops, which one should I expect them to go after? Which one are they going to respect? How do I know if it's not going to keep on going through an old high and not be a turtle soup sell? All those scenarios and those ideas, while I told everyone in the beginning, if you were just patient and waited, and all those questions would be answered. But some of you are just really, really impatient. And I get it, you're excited, and you think that you're not going to learn all this stuff in the remaining time of the mentorship. But trust me, I'm committed. You will learn it. There's tons of information coming to you, but you have to let me go through the process of teaching it. This isn't the first time I taught this stuff. So trust me, I've been successful in the past doing it, okay? So just go along with the process. But if we look at back in November, we can clearly see that there was a major market shift in November 2016. Now, what that does, it gives us a great deal of insight. We can't take a time capsule, travel back in time, okay, and be back in November and go short there, but we can use the information that our daily charts are telling us there. That means there was a great deal of displacement by the large players or smart money. When we see that in November, what we're seeing here is the underlying futures contract of the Australian dollar has a market shift right there. That's a quarterly market shift. Over the last 3 to 6 months, that's the most obvious one. You can clearly see it. If I was to ask everyone if we were all in the same room, raise your hand if you can clearly see that that is the most obvious market shift in the last 3 to 6 months. Everybody invariably would raise their hand. They would obviously, if you can see it, you can't deny it. That's what you're looking for. Every 3 months, there's going to be something like this occurring. It could be a sell-off, creating a high, or it could be a low where it starts to rally. But every 3 months, I want you to look at your charts and anticipate finding that in hindsight. Now, great. That's wonderful. You can see it in hindsight. What do you do with that information? See, this is what I have an issue with, like with Elliott Wave and all these other they're just very highly subjective. If the market really is influenced or controlled by smart money, or if there is, what I'm telling you, there's an algorithm that controls what price is going to do. It's absolutely not random. It's predetermined. It's running on a script that refers to specific data points that it will go back to over and over and over again. The IPDA data range, okay, you have a 20-day look back and cast forward range. You have a 40-day look back and cast forward range. And then you have a 60-day look back and cast forward range. What I'm suggesting to you is if you are looking at price and you see for instance, you have a market structure shift here and the quarterly shift occurs in November. That means that now the market is in a sell profile from that point until it gets to a level of significant counter direction. What would cause it to change direction or consolidate? That's the other thing. That's the vague green, not green, but gray area in the analysis. Sometimes you won't see a clear retracement or correction, opposite direction. For instance, it's been going down November. It could have very easily been consolidating here going into January, okay, and into February. It doesn't need to be a counter trend move like we're seeing unfold here since the last week of December. It can be a consolidation. And as we go further into the content for the January delivery of the information, we'll talk about when it does or when to anticipate when it's going to go into consolidation and not have a counter swing. So back in November, we see that there's a high made. What's really going on? That low here is broken. So we have a shift in market structure and it breaks lower. We know that. We can see it because it's taken out an area of equal highs, and we pierced above that, taking out the buy stop liquidity pool, and that's seen here. That was the basis and the framework around what caused the market structure shift. That quarterly effect comes in to operation at that moment, okay, where our eyes go immediately back to November because you can clearly see it. When you see that and you delineate that on your chart, what you're doing is you're now identifying the beginning of November. So you have to have a basis point. Where is it? Where did it all begin? Because if you don't get yourself in sync with what IPDA most recently did, and IPDA is the Interbank Price Delivery Algorithm, that's for your notes again, you're going to delineate where the most obvious one in the last 3 months has been. Then you're going to cast out 20 days, go forward from the beginning of the month that market structure shift or quarterly shift takes place. You're going to count out 20 days. Now, it may not even be 20 days. You may look at the chart and say, hey, this is an obvious one right here. Something's really going on. If you do that, you're really doing too much anticipation. You got to go back to the most obvious one, and it may require you going back 3 months. But find the most recent one where the market structure has shifted and there was a move that took place that was obvious, bullish or bearish, okay? And it's really easy if you just divide your daily chart into quarters, like put a line on March, put a line on June and September, December, and just keep doing that. Your eye will go right to where these quarterly shifts are happening. They're not going to always occur on those months. There's a little bit of gray area, which is the reason why we have a look back and a cast forward. The IPDA data range, okay, what it's really doing is it's highlighting you as the trader. You're going to try to mimic what this algorithm's doing. It's looking for the liquidity in the range of 60 days in the past. Where is the sell stops in the last 60 days? Where are the buy stops in the last 60 days? Where are the fair value gaps? Where's the price gaps that price has not been efficiently delivered in the last 60 days? Where are the liquidity voids where price has only been delivered on the upside, where it has to come back down to efficiently deliver price and balance it out by going back down and closing in that range? Optimal trade entries, that's where that comes from. Where are the equilibrium price points? Does it have to return back to equilibrium? Did we get too far ahead of ourselves? Did we extend too far? Do we have to come back and retrace, minor retracement, before we see the next leg lower? By looking at the market structure shift that takes place in this November time period, we are in essence saying that this is a quarterly shift. Therefore, because it's a daily chart, this is going to give us insight about what the market should do on a 3-month timeline, as much as 6 months. But I like to just remind you that I'm only really looking for about 3 months horizon, time horizon, that far out. I don't like to look beyond that. There's been many times I can show you in journals where I had it right, but just because I had it right doesn't mean I was executing on every trade. But many times I'm really accurate in about 4 to 6 weeks time horizon, and it's about the half-life of a 3-month cycle. So if I think that the time horizon is consistently derived at by looking at 3 months out, by using the daily chart like this, that's my belief. I'm firm in my belief that I believe I can teach you how to do that and have a 3-month horizon. By having that, that gives a great deal of opportunities for all disciplines of trading. Long-term position, swing, short-term, intraday, scalping, all that stuff can be done effectively by having this time horizon. But when we find the clear market structure shift that happens every quarterly, every 3 to 4 months or so, we find it, we identify the beginning of that month. You got to roll back to that first month. Why are we doing that? Why does it have to go back to the first of the month rather? Because if an algorithm, and I'm not sure if any of you are aware of how computer programs are made or designed, but when a systems analyst sits down with a company and they say, okay, look, this is what I want the output to be, or I need a report generator it's going to give me this outcome, or I need this information, or I need this computation made, I need this process done. Okay, the system analyst is going to say, okay, what data points are you making available to me, so I can sit down with my team of computer programmers, okay, and the analyst will make a documentation stage where he sits down and outlines the overall macro process. Now, because of what they're dealing with, they are taught and learn computer programming to some degree, but they are not doing the programming. They put all of the context around what is supposed to happen, what processes are there, if this is done, then this should be done as well, what checks and balances, and it's basically the documentation stage of the process of a computer program. Then the computer programmers take that information and they actually code it out. Now, a computer program and a computer programmer is completely, utterly blind and useless if he doesn't have data points to use. You can't have a computer program do anything of any value unless it knows where to draw data points from. There has to be an array of information coming to it to process and do calculations. So this was my epiphany. Okay, when I was sitting down with the folks that were introducing these ideas to me, and no, they're not in the teaching circuits. You're never going to meet these people, okay? But when I was introduced on how the markets actually work and operate, the fastest and most obvious thing I learned was there was no ambiguity to how price moves around. There was no randomness because they were talking about things that had a finite or origination where it wasn't like, it could have been this day, it could have been that year, it could have been this month. No, 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 no. It's absolutely nothing like that. If you understand it, we're going to be referring to things that are numerical, they are price related, they are value based. That means that we have to look at a specific level and price. But how does the algorithm go just to end the old price? How does the algorithm know that that's where the large fund stops are? See, this is what's taught and permeated in the teaching circuits in education for trading. They teach, and I've said these things before, but I used it to communicate to you the idea, because most people don't understand fund level trading. They don't understand institutional trading. They don't know those types of things. They just think, I got an account with my broker, so therefore I'm trading, and if I get stopped out, it's my broker that did it to me. And many times that's true. But the delivery of price from the central bank level, that movement, that repricing is really, not always, but on a short term, it's being repriced to take into account for large liquidity pools that are available on the large fund trading realm, not your little mom and pop FXCM, not your OANDA. You know, none of those things, okay, are obvious or on the radar screen for what I'm teaching you here, but they are in close. They're basically in alignment with the same thing, okay? But they're not, these movements for these runs on stops, they're not looking at, oh, here's Michael's stop. Okay, here's John Jones from Allentown, Pennsylvania's stops. Okay, they don't have that type of information. They don't see you. They don't have any identification of you. They don't have any identification to retail at all. But because these ideas are taught across the board the same way, because it's been put out there to be done this way. Because eventually, if you are an accurate trader that's a retail-based trader, okay, eventually, if you're profitable to some degree, what eventually happens to some of these people? They get very high-minded of themselves. They think they're great at what they're doing, so therefore they're profitable. And the first thing they want to do is prove it to the world by having everyone else give them their money, and they're going to be a trader that manages funds. No one wakes up and is born a large fund trader. They come up through the ranks of being a profitable retail trader. So are they going to come into that realm and change the way they've been doing things? Absolutely not. It's the same thing they're going to do there. Then the difference is they have a process on the fund level that they have to go through specific parameters and guidelines and stay within these to be compliant with whoever is running that operation behind the scenes. In other words, just because you're a large fund manager unless you're operating alone and independent. If you go to work for an agency and you are a fund trader and you're managing under their umbrella, then you have guidelines you have to work within. There's rules and things that you can't do outside of these, or you basically get canned. You're out the door. You're gone. You can't manage anything. They'll expel you. But these ideas are the same. So how can an algorithm or a computer, we'll just say it like this, how can a computer program know where everyone's stop is? It has to have a range of data. Now, just because we have the numbers of price, the value of price, okay, they have to have a look-back period. The look-back period is 20 days, 40 days, and 60 days. And what you're doing is and this is what I want you to do with your time after today's teaching while you're waiting for today's daily recap video, because there'll be two that go up. This is the teaching video for today, and then we'll have a daily review where I do like 10, 15 minutes talking about what's already happened, and I'll give you the charts and stuff to study. I want you to spend your time this evening, okay, and even tomorrow while we're not doing any live session, go back through your charts and don't just look at the Australian dollar. Look at every currency pair. Look at every commodity. Look at individual stocks. Look at indices. And you'll see quickly by studying this, it will become quickly clear that there's no randomness to it. There's a specific pattern that this thing does all the time. Now, it used to be a manual thing where the market maker was a real person. They sat there and they worked with a team of individuals that manipulated price to do these very things. But because everything has become so streamlined and efficient by artificial intelligence, AI, the effectiveness of algorithms, okay, that's been implemented now. It's much more efficient to do that. And there's no emotion. It just does what it needs to do. So if it's a computer program, or I'm quoting with my fingers now, the interbank price delivery algorithm, that computer program, we're going to call it from this point on for this teaching, for it to be effective, it has to know where to look at to find stops. They don't see orders. That's not what's going on. They don't see orders. The orders are executed on by the traders at the bank level. The algorithm just permits the price to move to that level, which gives the opportunity for the traders to execute on that run. That's the real story. That's what really goes on. Everybody else out there in this industry will tell you, well, it's this happening, and this guy here, he's pushing a button, and it's doing this to happen. No, it's not. It's not. That's not what's happening at all. The algorithm will look back 60 days, and it'll find, it's very easy. If you know anything about computer programming, and you don't even have to do that, but just look at this 1st of November. If you look back 60 days in the past, what was the highest high in the last 60 days? There's going to be buy stops above that high. What's the lowest low in the last 60 days? There's going to be sell stops below that low. In the last 40 days, what was the last highest high and what was the last lowest low? Looking back in the range to the left from that November red line that we're delineating in November, where are the stops below and above those highs inside of the range of 20 days, 40 days, and 60 days? Now, I already know what some of you are thinking. Well, what happens if there's a low that's really, really obvious, that's just outside the range of 60 days? That's the farthest extreme. That's when the open float will move aggressively and go outside that normal parameter of 60 days, and you'll see that big run. The market will jump and skip right down into that old low that's just outside that 60-day range. How do you know when it's going to be an explosive move, Michael? When you have that scenario. If in the last 60 days, if they've already ran out the stops below and low in the last 60 days, or above an old high in the last 60 days, and there is a larger, higher high or lower low where the stops will be resting above or below respectively, then you know there's going to be a big run on price, and they're going to run for that liquidity because that's the only other thing that's left. The large funds have their orders above and below these old highs and lows. You work just like the algorithm will in a 60-day range. Look back the last 60 days. And then you watch going forward. You cast forward 60 days. And you can literally have this on your chart. You go forward, count forward 60 days. You can literally go on your daily chart in MT4 and change your date 60 days forward to make a vertical line. And that way, as price starts to paint, you'll know you're approaching that 60-day. That means it's going to be forming some measurable intermediate term high or low before that time. And it's going to create a liquidity pool above an old high or below an old low. That's going to be influential for future trades. The same thing occurs by looking back on the last 40 days to the left of that November 1st. Look back 40 days. What was the lowest low? What was the highest low? I'm sorry, what was the highest high, rather, and the lowest low? Your buy stops above the old high and the sell stops below that old low. Inside of that range of 40 days, that's where IPDA will look for that liquidity. Now, it's not giving you directional bias yet. I'm telling you it needs to use these reference points to find where the stops would logically be. See, the AI it can't think for a human. It can't do that. But because human nature says that we will, as traders, put our sell stop below a low, and we will put a buy stop above an old high. That's all the algorithm's doing. It's seeking to take price to that level. When it gets to that level, then your broker, then the central bank can do a wild spike and send it above 10 to 20 pips. Think about it now, 10 to 20 pips. Then it becomes logical why they do those big spikes, okay, intraday, 10 and 20 pips above an old high. Then it stops many times right at 20 pips or 10 pips and then rejects it, goes the other way. It first has to get to those levels based on a daily chart in the realm of a 20 pip, 20-day, 40-day, or 60-day look back and then cast forward. So really what you're doing is you have 120 days of range from the past and going forward. There's going to be a significant move. Now, some of your friends, of course there's going to be a move, Michael. Come on. I mean, a lot can happen in 120 days. Yeah, you're right. But there's things that you have to look for that the algorithm's going to be doing to engineer these types of moves. You have to have these data points to know why the market's going to go at an old low. What old low? Well, where's the lowest low in the last 20 days? Where's the last 40 days? Where's the lowest low in that range? Where's the highest high in that last range? And you need to be noting those because that's the one that they're going to run. They're going to run right for those. If there isn't anything that hasn't been traded to in the last 60 days, if everything's been wiped out above and below the marketplace, in other words, the open float, all the buy stops above old highs, and all the sell stops below old lows in the last 60 days during your look back, in other words, everything to the left of that November vertical line, that red line, if everything's been cleaned out above and below the highs and lows, there's no more buy stops, there's no more sell stops, it has to create a new expansion. So you have to identify what the next high and low outside that range of 60 days, looking back, where that is. And that's going to tell you where they're going to draw price on this daily time frame. It's more confirmed when you start applying it to the weekly chart and the monthly chart, because you'll start seeing things align where that old low that's just outside of the last 60 days looking back, there's an old low that may not be on this chart here. I don't know. I'm just giving you a hypothetical example. If there's an old low that's just outside the realm of September in this example here, say maybe there's August, there's a significant lower low, the market's going to reach for that. There may be a high that's just outside the September boundary in August. They may have turned around here and they make a run for that. Maybe it may be in the 78 price range for Aussie. That's what you would be noting, and you're going to look for price to be drawn to one of those two price points, and you look for evidences that that institutional order flow is going that direction. Then you know where it's going. It gives you directional bias because of the higher time frame nature of this daily chart and weekly and monthly. So what we have here, this is the look forward, okay, or cast forward of November. This is 20 days out from the 1st of November. So we have 20 days here. Inside of that 20-day range, there's going to be a significant setup that you can use for your trading. It's moving up into the old low that was formed in October. It goes into consolidation. Well, here we have a condition where the market didn't create any significant shift, but it starts to move in consolidation. Then you count forward, okay, from here, that's the 20th. So you can go from the beginning of November to the 20th. Yes, there was a price swing, but using the information, the next stage would be 40 days out from that price point of November beginning. We have here. That is your 40-day lookout or cast forward. And you're looking for, again, a potential major shift quarterly. It can happen at that point. Now, it didn't give you the lowest low, because if you go back to the left, two daily candles or bars, the last down right here, this down candle, that was the actual low. We had a small little range in here, and then we came down and hit this level here, 71.50. That's the 40 days out from the beginning of November, framed on the quarterly shift that took place here. So we're anticipating a potential change in the direction, okay, 20, 40, or 60 days out. But that's the range. It's not always going to do like what you're seeing here, where it's almost calling the very day it moves and makes the change. You're allowing your study to say, okay, the price is going to move about 20 days, and then we could see something. If it doesn't happen in 20 days, okay, well, in the next 20 days, up to 40 days from where the market structure last shifted here, quarterly, then we're going to anticipate in the realm of the next 20 days, it may happen. So you have to be looking for signs that it's going to happen. If you don't do these things, you're going to marry the idea that the market's going to keep on going lower and never turn around. It doesn't do that. Markets don't trade in straight lines. So if we see here, on this day here, this is 40 days out from the beginning of November. Very significant price move occurred from that price, 71.50. I mean, I would think everyone, if we were all in the same room, if we raised our hand, if we were in agreement, I think the majority of us, if not all of us, would raise our hand and say, that's a pretty significant move off that level. One of the things I learned when I was an indicator-based trader, I like the stochastic, I like the Larry Williams accumulation distribution formula, where it plotted an accumulative line based on the relationship to open to close and close to open, and measuring that as some smart money buying and selling. While sometimes that's true, not always, and it didn't always give you a divergence. I liked his Williams percent R, and the reason why I liked his Williams percent R is because it has an uncanny ability to be one day before. Like if you look at stochastic, you have to wait for the candle to close and go to a new candle to see if the K line crossed the D line or D line crossed the K line or whatever it is. I don't even remember what it is anymore. But the trigger line that uses the idea behind a crossover for stochastic, that has to happen after the fact. Well, the market's already moved. When I looked at the percent R, what that did, it gave me many times the day before the real oversold condition would happen. For instance, if the oversold condition existed in the Williams percent R, today, that means tomorrow it's probably still likely to go down just a little bit more, but that's going to be the buy day. That's the very low low. Well, that same phenomenon sometimes occurs with these ranges. 20 days out, you may get if it doesn't turn, it may happen on the 21st day, or it may occur on the 19th day when it does occur. But that's not what you're relying on. So it's important that while that may have magic in your chart sometimes, you may see it happen, it might do the very thing of turning on the 20th day or the 40th day or the 60th day. And you saw that in my first teaching for the month. I wish I probably would have stressed it more, because everyone seems to think that that's what's going to happen. I'm not telling you that the market turns every 20 days, every 40 days, and every 60 days, but it can and will sometimes do that. What we're looking for is these quarterly shifts to take place. Once we identify one, there's our beginning point, okay? But you have to roll back to the beginning of that month it occurs in. It occurred in the second week of the month of November. So we're calibrated. Now we can start going forward until we see a equal or counterparty to that move going lower. It has to be a significant retracement or correction or reversal. It's indicating that here, the last week of December. Why is it doing that? Because we've taken out December's high. You see that? We're trading at a level where if this was continuously bearish, it shouldn't be where it's at right now today. Okay, but my point in drawing your attention to the 40-day is it was not the 40th, it wasn't the fact that it made the lowest low and turned on that day, but look at the low in proximity to the lowest low that was formed here. Inside, this day here was inside the range of 40 days back to this price point here. So from this level, looking at the first day on November, casting forward 40 days, this whole turning point right here could have happened any time in the last 40 days. Now again, for some of those that are cynical, of course, obviously, this is of no value. It's a great deal of value, because inside that 40 days, just like when we look back for 40 days and look for the low for sell stops and we look for the high for the buy stops, in this range here, what is this? That's a low. Below that low is going to be what? Sell stops. Yes, we moved about 150 pips or so below that, but we came to a level of 7150. That's not random. 7150 is a significant level. It's a mid-figure level, and it's happening at a time when inside of 40 days the IPDA data range is going to be looking to do something. It has to do something. Every 3 months, price is going to be pushed around. It's going to be drawn to a level, or it's going to repel from a level. And it's based on what I'm telling you here. It's seeking large fund liquidity. Now, longer term, where we're talking about monthly and yearly moves, they are all driven by real fundamental things like interest rates. But every quarter, there's going to be a ebb and flow that takes place, a rally and a decline. When this occurs, that's all short-term in nature. When you look at long-term trends that go for 5 years or 10 years, 3 months is nothing. That's like a 5-minute chart on the scheme of a weekly chart. It doesn't mean anything. There's no significance to it at all. Long-term macro fundamentals, okay, are not impacted by 3-month cycles. They're not. They can be used to get in sync with long-term macro fundamentals, but the only fundamentals you're going to get from me is interest rates, which is going to be taught to you this month as well. So again, in summary, the 40 days, and I'm not done teaching, but for 40 days, this range, we're looking back, because see now here we have a new 40-day look. We're casting forward 40 days, so that at that moment, we're going to have that in our charts. From this point here, we know 40 days from then, this is where we would have our expectation of a shift. But we also, because we can do that in advance, we can now look back 20 days from there. We can look 40 days back from there. Where's the lows and where's the highs? Think about that. If we know at this point here, casting 40 days forward, we can have a vertical line right here on our charts. Now, to someone looking over your shoulder, they'd be like, why is that line even there? Why do you have a vertical line there? I don't know. I ain't telling you. You weren't part of the mentorship. But from this point here, counting back, let's do it. Here's you got to count this day as day one. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Okay? So 20 is basically the last day before you get to December. So the second to the last day in November is 20 days back. What was the highest high formed in that range? It's going to be mid-December, where it made those equal highs. So there's going to be what's resting above that? Buy stops. So what is the IPDA algorithm going to do? It's going to seek that liquidity. It's going to go up there and take that. Which high should I look for, Michael? That one. Looking back from this point here, because we know it from this point here, casting forward 40 days, okay? Going back 40 days, well, that's going to be in the range that's delineated here with this line that we've already shown. This is the low. Is there any significance about that low? Well, I'll counsel you to go into your 4-hour, 1 hour, and 15-minute time frame and put up 7,300 on your Aussie dollar and see what you see. There's nothing random about this stuff, folks. That low is 40 days inside the 40-day range Okay, that is a significant turning point. It's not the very lowest low, but you can see that the low forms 2 days before that. And then we have a market structure shift, and the market starts to go opposite to what has been put in place in November. You can now also, from that price point there, by having a vertical line on the arrowed daily range, you can now start counting forward 20 days, 40 days, 60 days, until you see an obvious shift quarterly. There's a major structure shift, okay? It could be bullish or bearish, whatever one it happens, it doesn't make it, you're not trying to forecast that. All you're doing is anticipating another significant move in price on a daily chart, and it happens every 3 months. But the point is, the IPDA data ranges give you a means of looking back 20, 40, and 60 days from specific days and specific price points, because then you'll know what stops they're going to be reaching for above an old high and below an old low. It's not just, well, I'm looking for the most recent obvious high and low. No. It's not like that at all. It's not like that at all. You got to look back in a range of 20, 40, and 60. And then if all those levels have been cleared out, then you got to look outside that range. Then you know you're getting ready to see a big move. And if it has these characteristics, then you know you're going to see a larger move higher or lower based on what those highs and lows would be outside the most recent 60-day look back.